Hello, and welcome to another session of Stop, Look, Listen, and Learn. Today, we're going to provide a brief introduction to portfolio management. And the goal here is to give CFA and FRM candidates the things that they need in order to be successful in passing their exams. So let's first start off by taking a look at the agenda that we're going to be following today. So we'll start off by first, excuse me, providing an overview of what the goal of portfolio management is, or in other words, what is portfolio management all about? And then after doing that, we're going to look at a two-asset portfolio, and we're going to examine various metrics relating to a two-asset portfolio. And then after doing that, we will extend those things to an asset or to a portfolio with more than two assets. So with that, let's jump right in and get started. So, the goal of portfolio management, quite simply, is to maximize returns while simultaneously minimizing risk. You can think of the returns as the product that you want and the risk as the price you have to pay for the product. And so, just like with any product, you want to get the best, largest, most high quality product that you can get for the least amount of money. And so the same thing is true with portfolio management. You want to structure your portfolio in such a way that is going to maximize the returns that you get while at the same time minimizing the amount of risk that you have to take on in order to get, those returns. And so that's kind of the overarching principle of portfolio management that I think you should keep in mind as you get more involved with portfolio management because it'll help keep you grounded in terms of what is actually going on there. So take a look at a two asset portfolio. Okay, so we're going to start off by making a simplifying assumption. And that simplifying assumption is that there are only two assets in the universe. There's asset one and there's asset two. And we have a portfolio that we're going to be putting together. And in that portfolio, we're going to have a certain amount of money. It could be $100,000. It could be $1 million. The amount is not really that important. But the important point is that we're going to take whatever money or assets or resources we have at our disposal, and we're going to invest those resources in assets one and or two, right? So we have a few options here. One option would be to to invest all of our resources into asset one and none of our resources in asset two. Or we could invest all of our resources in asset two and none of our resources into asset one. And another option would be to split our resources between asset one and asset two. And if we decided to do that, then there are a myriad, almost an infinite number of combinations of asset one and asset two that we can have within our portfolio. And the amount that we invest in asset one or asset two, that's going to be referred to as the weight of asset one or asset two. And you compute the weight by essentially taking whatever portion of your total resources that you invest in asset one and you divide it by the total amount of your resources. So, for example, if you have $100,000 in resources and you invest $50,000 in asset one and $50,000 in asset two, well, then the weight of asset one would be 50% and the weight of asset two would be 50%. And your weights have to always sum to one. Uh, and what we're going to be discussing today would be situations where all the weights will be positive, but keep in mind that the weights do not have to be positive because you can have short selling where you have negative weights applied to a certain asset, and then you have a weight that's greater than 100% applied to another asset. But when you sum all the weights, they must sum to 100, regardless of whether all the weights are positive or some of the weights are positive and some of the weights are negative. So just keep that in mind. Okay. So the first thing we want to do is we'll look at the expected return of a portfolio. As we said earlier, the main goal of portfolio management is to maximize the amount of return. So something that's going to be important is figuring out how do you compute the return of a portfolio. So let's start off by taking a simple case. Let's say come down here to the bottom here and we decide to invest 100% of our resources into asset one. So here the weight would be 100%. And if we come up here to the table, we see asset one has a return or an expected return of 12%. So let's say we have $100,000 and we invest all of that $100,000 into asset one, and asset one returns 12% over the next coming year or period, whatever the case may be, well, then our return is going to be 12%, right? Because all of our resources are invested in asset one. If we invest $100,000 and it returns 12% over the period, then we're going to have a $12,000 return or 12% return, right? And by the same token, if we decide instead to invest all of our assets in asset two, and asset two has a 6% return, well, then we're going to have a $6,000 return over that 1 year period, assuming, we have $100,000 invested in it. And so in each of those two cases, the amount of the return that the portfolio will produce would be a function of the returns of the asset that the portfolio uh, was invested in, right? Now, so that's pretty simple there. So you take essentially, if we look at the first scenario where you invest 100% in asset one to determine the return on the portfolio, we would just simply take the weight of asset one, which in that case would be 100%, and we will multiply it by the return of asset one, which is 12%, we're assuming, and that will produce a return of 12%. And likewise, if we instead had decided to invest all of our resources in asset two, then we would take the weight of asset two, which would be 100%, and we would multiply that by the return that asset two produced, and we would get a 6% return. So that's pretty simple and straightforward. Now, let's look at a more likely scenario, which is where we would take our resources and we would invest some of those resources into asset A, and we would invest some of those resources into asset one, and we would invest some of those resources into asset two. And let's just pick a line now here. Let's say we decide to put 20% of our resources in asset one and 80% of our resources in asset two. And let's further assume that that asset one produces a 12% return and asset two produces a 6% return, right? So in that case, to determine what the return of the portfolio would be, we would take the weight of asset one, which would be 20%, and we would multiply that by the return that asset one produced, which would be 12% in this case. And then we would take the weight of asset two, which would be 80% in this case, and we will multiply that weight by the return that asset two produced over that period. And then we would take the sum of those two products, and that would tell us what the expected return of the portfolio would be, or what the return of the portfolio was if we were looking at this in hindsight, where we say, okay, we invested 80% in asset one, and 20% in asset one and 80% in asset two, and over the prior year, asset one returned 12% and asset two returned 6%. Well, then we can look at that and say, okay, well, the return on the portfolio is 7.2%. And so basically what this tells you is that the return on a portfolio is simply a weighted average of the returns of all of the assets within the portfolio. So we can pick any, different combinations of asset one and asset two. So let's look at a simple one. 50, if we invest half of our resources in asset one and half of our assets and resource in asset two, well, then the expected return or the actual return, depending on the case, would be 9%. And that's easy to see. So if you take half of 12%, that's 6%, and half of 6%, that's 3%, and 6 plus 3, that's 9%. So that's basically how it works. So basically, what you would do is you would just take the weight of I and multiply it by the return of asset I, and you do that for all of the assets that are within your portfolio, and then you sum those products, and that will tell you what the return of the portfolio was, or if you're dealing with expected returns, it will tell you what the expected return of your portfolio is. And so really that's all that it is to it in terms of computing the return on a portfolio. And remember, what the goal here is, or the goal of portfolio management is to maximize the return on the portfolio while simultaneously minimizing the risk inherent in the portfolio. So now let's look at risk here. Now, so when I say risk, that is usually referring to volatility, and volatility is referring to the standard deviation of the return. So basically, risk, standard deviation of returns, and volatility, those things are all synonyms, so they're used interchangeably. And so here we're just going to say we're going to be looking at the volatility or the standard deviation of the portfolio returns, right? Now, let's take the simple case where we invested all of our assets in asset one. And in that case, the return of the portfolio was simply a function of the return that asset one produced. So whatever return asset one produced, that was going to be the return of the portfolio. So let's say that over the prior year, the asset one produced a 12% return, and we invested 100% of our portfolio in asset one. So we would have a 12% return. Now let's look at the next period. Now, what is the return of the portfolio going to be in the next period? Well, it's going to be a function of whatever the return is of asset one in the next period. So the return that asset one produces in the next period can be above, equal to, or below 12%. And whatever that turns out to be, that's going to be the return of the portfolio, right? So that's pretty simple and straightforward. So if you're trying to get a sense of the volatility or the standard deviation of the returns of the portfolio, and where it's invested all in asset one, well, then you just simply look at the volatility of asset one, and whatever the volatility of asset one is, that's going to be the volatility of your portfolio. But let's now look at a scenario where you invest your resources in both asset one and asset two. And let's just take a simple case here where you invest 50% in asset one and 50% in asset two. So there we saw that your actual return would be 9%. That is, half of 12 and half of 6. You add those together, so you got 9%. Now, what is going to be the return on the portfolio in the next period? Well, in this case, the return on the portfolio is simply going to be a function of the return that asset one produces in the next period and the return that asset two produces in the next period. So uh, then we got to look at, okay, uh, if asset one produces a return that's above 12% or its return increases next period, what will asset two's return do? Will asset two's return increase as well, or will it stay the same, or will it decrease? And so, in other words, we gotta look at or take into account how the returns of asset one and asset two vary or co-vary, if you will, right? And that being the case, what we have to do is we have to use this formula here to first compute the portfolio variance. And here we're assuming that you have some basic uh, understanding of variance and standard deviations, which is simply the square root of the variance, if you will, right? And if not, I'll have some other videos that you can take a look at to help you get up to speed in terms of how to compute variance and standard deviations and the like, right? But so basically, we want to look at the variance of the portfolio. So that's what we have to start off with first. Now, if we look at this little matrix over here, we have asset one and asset two uh, on the vertical column, and then asset one and asset two on the horizontal row. Now, in this first box here, so we're gonna this is what we refer to as a variance covariance matrix, right? So first we're going to look at, how will the return of asset one vary? And so that's going to be the covariance of asset one with itself, right? And that is what we refer to as the variance. So we're going to be looking at the variance of asset one, because that's going to give us some sense of and contribute to the overall variance of the portfolio. And then we also have to look at the variance of asset two, and because that will also contribute to the overall portfolio variance, right? And then if you look at this formula, you see we're going to take the weight of asset one and we're going to square that weight, and then we're going to multiply that by the variance of asset one, and then we're going to add to that the product of the weight of asset two squared and the variance of asset two, right? And so that's the beginning part. Now, because as we stated earlier, the return on the portfolio in the next period is going to be not only a function of the returns of asset one and asset two, but it will also be partially a function of how the returns of asset one and the returns of asset two covary. I mean, do they move up at the same time? Do they move down at the same time? If one is moving up, does the other one move down? If they both move up, do they move up by the same amount? And if they both move down, do they move down by the same amount? So that's what we got to take into account. And that's what this covariance is between asset one and asset two. We're looking at how they actually move together, right? Now, the covariance is simply the what you do to compute the covariance is you take the expected return, or which is the average return, then you look at the differences between the actual returns and the average or expected, then you take those differences and you square those differences, right? And so that's basically how you compute the covariance, right? And the covariance basically can range from negative infinity to positive infinity. That being the case, it's really kind of difficult to interpret the covariance. So as a result, what we end up doing is standardizing the covariance, and we standardize the covariance by dividing it by the product of the standard deviations of asset one and asset two. And when we do that, we end up getting something that's called the correlation coefficient. And now the correlation coefficient or the correlation between asset one and asset two will range from a low of -1 to a high of +1. And -1 would mean that they were perfectly negatively correlated, and +1 would mean that they're perfectly positively correlated. And what those terms mean is that if they're perfectly positively correlated, if asset one's return increases by 1%, asset two's return will also increase by exactly 1%. And if they're positively negatively correlated, what that means is that if one returns increases by 1%, then asset two's return is going to decrease by exactly 1%. So you have, the set off there, right? And so what we're assuming in this case is that the correlation between asset one and asset two's return is zero point 0.3. So there's a slightly positive correlation, meaning that when the returns of asset one goes up, the returns of asset two will go up, maybe not quite as much, but they tend to move together, but not entirely in sync, right? And so there's a formula here that I want to highlight that you definitely want to know for the exam, and that is the covariance of between any two assets would be equal to the correlation coefficient of those two assets times the standard deviations of those two assets, right? So if you were to move the two standard deviations down here, so in other words, if you divide the covariance by the product of the standard deviations of the two assets, then you get the correlation coefficient. And dividing the covariance by the product of the two standard deviations. That's what we refer to when we say we're going to standardize it so that we can get a metric that we can more easily interpret, right? And so what you have here is two times the weight of asset one and asset two multiplied by the correlation coefficient of asset one and asset two times the standard deviation of asset one times the standard deviation of asset two. And you drop in all of those numbers, which they'll have to give you for the exam, and then you're going to get the variance of a two asset portfolio, right? And then, of course, if you want to get the standard deviation or the volatility of the returns of the portfolio, then you simply take the square root of the variance, and that is what you would get there. Now let's look at a couple interesting things. Now let's look at the scenario where we put half our money in asset one and half in asset two. Now, if we do that and we look at sigma, so this is the standard deviation of asset one, the standard deviation of asset two. So you can see the volatility or the standard deviation of asset one is higher than the volatility of asset two. So you would say asset one is it's more risky than asset two. And that makes sense because the return you're going to get on asset one is greater than the return that you're going to get on asset two. And that's consistent with the, uh, you know, understanding or statement that there's a positive relationship between return and risk. The more return you get, the more risk you got to take to get it, right? But going back to this, so if you put 50% in each one of the assets, so if you were to take a weighted average of the sigmas of the assets, that would be 20%. Because if you took 50% of the 25, that's 12 and a half. 50% of the 15 is 7.5. You add those together, you're going to get 20%. But as you see here, that is not the standard deviation of the portfolio when you when you allocate 50% of your portfolio to each one of those assets. What you see is that the actual standard deviation of the portfolio is less than what the weighted average of the standard deviations of the two assets is. And that's because of what we refer to as the diversification benefit. So, anytime, and this is something you want to put in your notes, this is one of those stop, look, listen, and learn moments. So, anytime that the correlation between the two assets is less than one, then you're going to get some diversification benefits. And what that means is that, in layman's terms, is that when you combine those two assets into your portfolio, the standard deviation of the portfolio will be less than the weighted average of the standard deviations of the assets containing or comprising the portfolio, right? And so you can see that pretty clearly here. And so basically the takeaway from this slide is that, you look to see how much you invest in asset one, how much you invest in asset two, and then they're going to give you the standard deviation of asset one, the standard deviation of asset two, and they'll have to give you um the covariance of asset one and asset two, or they'll give you the correlation of asset one and asset two. And so let's say if they just gave you the covariance of asset one and asset two, and you also have the standard deviations of asset one and asset two, then you can, in that case, you could just drop the covariance into this equation here. But probably more likely, they're going to give you the correlation coefficient of the two assets and then the standard deviations of the two. And you'll have to know that the correlation coefficient multiplied by the product of the standard deviations of the two assets will be equal to the covariance. And that's what you drop into this formula here to tell you what the portfolio variance is. And you take the square root of the variance to get what the standard deviation of the portfolio is. And the standard deviation of the volatility of the portfolio, that basically tells you, how risky your portfolio is, in a sense. So a portfolio that has a really low Volatility means you're not going to have a lot of changes from year to year in terms of the return of the portfolio. But one that has a lot more volatility means that there's going to be a lot more uncertainty in terms of what the return of the portfolio will be over the next period. And so again, what you want to do is you want to maximize the return that you get on your portfolio while at the same time minimizing the volatility of those returns. Ideally, you would like to get 100% return for each of the next 10 years without any deviation. I mean, that would be great, versus getting 100% return one year, to losing 50% one year, the next year losing 75%, and getting 150% return the next year. So it's all over the place and it's a lot more volatile. And so that's basically, as I said earlier, what portfolio management is all about. You want to maximize the returns of the portfolio while at the same time minimizing the volatility of the portfolio. And you do that by uh, judiciously selecting which assets will be included within the portfolio, one, and how much you're going to invest in each of those assets, or in other words, what the weights of the various assets will be. Now, let's take a look at a scenario where, as I said earlier, one of the things we want to do is to minimize the amount or minimize the variance or the volatility of the portfolio. So let's say you have the two asset portfolio here, and you're given this data on these two assets, so you see the standard deviation of the two assets, expected return, you see what the correlation is. And so what you want to do is you want to figure out, okay, well, there are almost an infinite number of different combinations of asset one and asset two that I can put together to form this portfolio. But of all those different combinations of asset one and asset two, which of those combinations will minimize the variance or volatility of the portfolio? And so on the exam, they very well could give you this information and say, okay, the portfolio manager wants to minimize the variance of the portfolio. So how should the portfolio manager allocate the funds in the portfolio? I mean, the resources of the portfolio between asset one and asset two. And so basically, what you want to do is you want to minimize, this number here. And basically, just to give you a peek behind the curtains, what you would do is you would take the partial differential of this equation here with respect to the weights, and then you would set that derivative to zero, and then you solve for W, and that would tell you what amount you should invest in asset one and what amount you should invest in asset two. Now, fortunately for you guys on both the CFA and FRM, you're not going to have to use calculus. You're just going to use the result of going that comes out of that process, and that's the result down here. So this is the formula here. This is another stop, look, listen, and learn moment here. You definitely want to commit this formula here to memory because there's a high probability, particularly on the FRM exam, that you're going to have to use this. You may have to use it on the CFA exam as well. But essentially, what you're going to do is you're going to take the variance of asset two, you're going to subtract from that the covariance of asset one and two, and that's going to be the denominator, and you're going to divide that difference by the sum of the variance of asset one and the variance of asset two, and you're going to subtract from that sum two times the covariance of asset one and asset two. And what that is going to yield would be the amount or the weight that you should invest in asset one. And then, of course, we're dealing with with the two asset portfolio. So whatever you invest in asset one, you subtract it from one, and that's going to tell you how much you should invest in asset two, because remember, the weights in all cases must sum to one. And so you might be wondering here why I have this 18.1% and this 81.9%, and that's because given this set of these metrics or parameters here, the portfolio that minimizes the volatility or the variance would be investing 18.1% into asset one and 81.9% into asset two. And if you do that, that will minimize the standard deviation or the volatility of the portfolio, and that minimum amount is 14.31%. And I'll just kind of put this out here just so you can see it. With this particular portfolio, given the weights, you would earn 7.09% return on that portfolio. And graphically here, I was just kind of drawing this graph, and this is based on the correlation of zero point 0.3 that we discussed earlier. And so as you can see it here, so this is standard deviation, which is the square root of the variance along the x-axis, right? And so if we were to invest 100% in asset two, which would be this point here, then the standard deviation of the portfolio would be the 15%, right? And by the same token, if we were to invest 100% of the portfolio in asset one, the standard deviation would be 25%. But let's say, so if you start off with 100% of an asset of the portfolio in asset two, and you start to add more and more of asset one. So in the beginning, as you can see, the risk of the portfolio is going to decline as you add more and more of asset one to the portfolio. And at the same time, the return of the portfolio is increasing as well. And it's going to reach a minimum point. And then at that point, as you continue to add more and more of asset one to the portfolio, the standard deviation or the volatility of the portfolio will start to increase all the way up to the point to where you reach 100% of asset one within the portfolio, and then you're at 25% there. And as you can see that, so if you start off with 100% in asset two, as we saw here, and then you add 18%, 18.1% of asset one to the portfolio, then you can see the standard deviation of the portfolio declines from 15% down to 14.31%. But then as you start to add more and more of asset one to the portfolio, in fact, if you add more than 18.1% of asset, if you allocate more than 18.1% of the portfolio to asset one, then the standard deviation of the portfolio starts to increase, and it increases more and more and more as you add more and more of asset one to the portfolio. And so you can top out at 100% here, in which case the standard deviation of the portfolio would be 25%, which makes sense because that's what the standard deviation of asset one is. And if the portfolio is invested solely in asset one, well, then it's gonna have the same, excuse me, standard deviation that asset one has, right? And so the main takeaway here is to know this formula here, because it's definitely conceivable that on the exam they can ask you what weights would minimize the portfolio variance or standard deviation of the portfolio. You need to be able to pull this out and use it. You know, you just knowing this formula is going to save you a lot of time, right? Now that let's look at two special cases. The first one is where you have where the returns are perfectly negatively correlated, and the second one is where the returns are perfectly positively correlated. And just going back to the prior slide, whenever the correlation is between -1 and +1, you're going to get a curved line. And what that line is going to look like is going to be a function of the correlation, right? So just think it's going to be curved if the correlation between the two assets is less, it's between -1 and +1, right? Now, if the correlation is -1 or +1, then this is what you're going to get. Now, this line here is what the graph will look like if the correlation is one, which means that they're perfectly positively correlated, which means that if the return on asset one increases by 2%, the return on asset two is going to increase by exactly 2%. If the return on asset one declines by 5%, then the return on asset two will also decline by exactly 5%. So they're perfectly positively correlated. They move in lockstep, right? And so when that is the case, you do not get any benefit uh, by combining it. So there's no depreciation benefit. So again, this is another stop, look, listen, and learn moment. You definitely want to have somewhere in your notes that says that if the returns of the two assets in a two asset portfolio are perfectly positively correlated, then there's no diversification benefit. And in fact, the standard deviation of the portfolio is just simply going to be a weighted average of what the standard deviation is of those two assets. And you can kind of see that here. Let's go to the role where you invest 50% in asset one and you invest 50% in asset two. And you have perfectly positively correlation, then you can see that the standard deviation of the portfolio is 20%. And if you take half of 25%, that's 12.5%. And if you take half of 15%, that's 7.5%. And you add that to the 12.5%, you get 20%. And so you can see that's what the standard deviation of the portfolio would be when you invest exactly half in asset A and exactly half in um, asset B. Now, just to make the point here, let's go back to the other slide. Now, here we're investing half in asset A and half in asset B, and we see that the standard deviation of the portfolio is less than 20%. And that's because you have a correlation that is between or that is less than -1. And as long as that correlation, it's less than +1, and as long as that correlation is less than +1, you're going to get some diversification benefit. And when you say diversification benefit, all that basically means, in a nutshell, is that the standard deviation of the portfolio is going to be less than the weighted average of the standard deviation of the two assets, right? And so that's pretty much the closest thing to a free lunch that you're ever going to find in finance, if you will. Now, let's look at the scenario where the returns are perfectly negatively correlated, meaning that if the return of asset one increases by 5%, the return on asset two is going to decline by exactly 5% and vice versa. So there's a complete offset, if you will. So when you have perfect negative correlation, you can actually get a scenario where the uh, standard deviation of the portfolio is reduced to zero. And so we can see that. So again, let's say we start off with 100% of the portfolio invested in asset two, and then we start to add more and more of asset one. So as we add more and more of asset one, because the returns are negatively correlated, you can see the standard deviation declines as we add more and more of asset one, and it declines all the way to zero. And once it hits zero, as we continue to add more and more of asset one, then it starts to increase again. And if we continue to add more and more of asset one and get to the point where we invest the entire portfolio in asset one, well, then the standard deviation of the portfolio is back at 25 here. And you can see that from the table. So with 100% of the portfolio invested in asset two, you see that the standard deviation is 15%, and that makes sense there. But as you start to add more and more of asset one, you see the standard deviation starts to decline. And at 37.5% invested of the assets invested in asset one and the balance invested in asset two, you can reduce to zero the volatility or the standard deviation of the portfolio. And so that's the minimum variance portfolio. And again, if you want to find that and it's not unreasonable to think that they may ask you something like that. What weights would um, reduce the variance of the portfolio to zero, given, all these this data here, well, then you would use this formula here to tell you how much you should invest in asset one and how much you should invest in asset two. And as you can see, if you invest this amount in asset one and this amount in asset two, then you reduce the variance of the portfolio to zero. So in other words, this is the minimum variance portfolio, right? And then you can see what the return of that portfolio would be 8.25%. And then as you can see here, as we went over here, as you continue to add more and more of asset one to the portfolio, then of course the standard deviation of the portfolio starts to increase more and more. And then you get to 100% of asset one, then you back up to 25%. And so those are the things that you definitely want to take away from this and know for the exam. So you definitely want to know what weights would minimize the portfolio variance, if you will, right? And yeah, and so if you're comfortable doing all that, you're going to be fine on this topic on the exam. So these are the types of things that they definitely like to cover and make certain that you know. So now let's extend those concepts to a portfolio that has more than two assets. I mean, because let's face it, that was a pretty unreasonable assumption to assume that the universe contained only two assets. I mean, there are, a myriad of assets. I mean, the S&P 500, that's 500 stocks there. Now, the assets could be stocks, it could be, commodities, real estate, it could be pretty much anything you want, right? And so you can have, a lot of different asset classes within your portfolio, if you will, right? So here we're going to look at a portfolio consisting of four risky assets. And that's the other thing I want to underline here is that, in all these cases, these assets, their standard deviations are above zero, which means that there's risk associated with them. If you had an asset that had a standard deviation of zero, maybe a treasury, short-term treasury bond or something like that, well, then that wouldn't be a risky asset. That'll be what they refer to as a risk-free asset, if you will, right? So these are all risky assets, and we're assuming that we have four of these risky assets in our portfolio, and we see the standard deviations of each of those four assets, and the prior return or the expected return of each of these four assets, right? And again, picking up on what we talked about earlier, I mean, the return of any asset is simply a weighted average. Is equal to the weighted average of the return of all of the assets within the portfolio. So here, we're going to let's take this portfolio here. So we take the weight of the portfolio or the portion of the portfolio allocated to asset one, which is 31.9%. We multiply that by the return on asset one, which is this here. Then we add that to the product of the weight of asset two and the expected return of asset two. That's this, and then we add to that the weight of asset three times expected return of asset three, and that's this one. And finally, we take the weight of asset four and we multiply that by the return of asset four, and that's this. And we sum all those together and we get the return on the portfolio as 10.03%. And so, as I said, that's pretty easy and straightforward because it's just simply a weighted average of all of the assets there. Now, so you could have four assets, or you could have 104 assets, or 1,000. You would do the same. And on the exam, you might get something like this. But again, it's pretty simple and easy to uh, to compute. Okay, so now let's continue on. So now here is where it gets a little bit interesting here. Now we're dealing with the four assets. Now on the exam, you're very, very likely, I'll say about 80% likely to get problems dealing with two assets, portfolios where you have only two assets. You may get a problem where there are three assets if, the test writers were in a particularly bad mood when they put the test together, but just because it's so time consuming and you're not going to have access to a computer like Excel, Python, or any of those software programs, you're just simply not going to be able to have enough time. You're not going to have enough time to do much or of anything other than maybe compute the return of a portfolio consisting of four assets, right? But let's just look at what you would have to do just in case you wanted to know, or you got uh, a portfolio with three assets on the exam, which you probably could happen. Probably lower probability that that would happen, but I would say it's almost the probability of you getting a portfolio with four more assets on the exam is probably close to zero, just because you just wouldn't be able to do that. And if that happened, I wouldn't waste any time. I would just circle B or C, whatever your favorite number is, and move on to the next one, right? Okay. So again, we got assets one through four here. And again, the weights must always sum to zero. And again, in these cases, we're assuming that the weights are equal to zero or equal to or greater than zero. Or in other words, we're not assuming that there's any short selling going on, but there could be short selling. So if one of these weights is below zero, then that means at least one or more of these other weights must be above 100%, so that when you sum them all together, they sum to 100%. So they must always sum to 100%. So just kind of keep that in mind. Okay, so you can see this portfolio variance here. Now you can see this formula is substantially longer than the first one that we looked at, right? And the reason for that is this. So if you look at this variance covariance matrix, so the first one we looked at, we had only two assets. Well, this one we have four assets. So uh, at a minimum, the variance of the portfolio is going to be a function of the variance of asset one, the variance of asset two, the variance of asset three, and the variance of asset four. And that's variance of one, variance of two, variance of three, variance of four. And in addition to those variances, we're going to have to take account of the covariances amongst these various assets. So there's going to be a covariance between asset one and asset two, between asset one and asset three, asset one and asset four. And then there's also going to be covariances between asset two and asset three, and covariances between asset two and asset four. And then finally, there's going to be a covariance between asset three and asset four. And for each one of those six covariances, we have to take account of that, and we have to include those in the formula here. So this is the first one, the second one, the third one, the fourth one, the fifth one, and then finally the sixth one. So just imagine on an exam you had to compute all this and drop all those numbers in and go through and compute that. I mean, that would take you at least, 7 or 8 or more minutes to do that. And so it's just not reasonable. But this is, kind of what you would do. And then, of course, if you had access to Excel, you would use like the matrix multiplication or whatever to figure that out. And if you're in Python, you would do whatever you do in Python to figure it out pretty quickly, right? But at any rate, you compute the variance of this portfolio. And once you get the variance of the portfolio, you get the volatility or the standard deviation of the portfolio by simply taking the square root of the variance. And that will tell you what the volatility of the returns are. So as you can see here, the return of the portfolio in any period is going to be a function of what the returns are on each one of those uh, four assets, as well as what the covariances of those returns are amongst those four assets. But this is basically how you would extend those, simple concepts to portfolio that has more than two assets. And just as an aside, if you got four assets here, then you're going to have six covariances that you have to take account of. And the way you determine the amount of covariances you have to take account of, that is going to be equal to n times n minus 1 divided by 2. So here we have 4. So 4 minus 1 is 3. times 4 is 12, divided by 2 is 6. When we had only two assets, so it would be 2 minus 1, which is 1, times 2, which is 2, and 2 divided by 2 is 1. So we had only one covariance, right? So you can do the math there. So if you want to build a portfolio that has all 500 or 493 or however many, or 503 stocks in the S&P 500, well then, let's say it's 500 stocks, so you take 499 times 500 divided by 2 and see what number you get. And whatever that quotient is, that's going to tell you how many different covariances you will have to take account of, which basically means that this formula here might be a mile long. So that's pretty much what I wanted to cover in this video here. Again, just wanted to summarize, the key important points of portfolio management. And as I said earlier, the key guiding principle that you want to keep in mind is that portfolio management is all about maximizing the return for a given level of risk. And stated differently, for a given level of risk, you want to maximize the return. And so that's really what it's all about. That being the case, first thing you got to be able to do is compute the return that a portfolio generates, and then you got to be able to compute the volatility of the risk of the portfolio. And those are the things that you need to be able to do mechanically. And then, of course, there could be some theory questions, like, for example, what uh, do you get a depreciation benefit if the correlation of the returns is exactly one? If you're dealing with a two asset portfolio and the like, and things of that sort. So if you understood all this, I think you're going to be in really good stead for the exam, and I think you'll do really well. And with that, I want to thank everyone for watching. If you have any questions, please feel free to drop them down in the comment section, and I'll do my best to get back to you. And if you thought this was helpful, please share it with your colleagues and other candidates that you know. And also, don't forget to subscribe to our channel. Thanks, and best of luck on your exams.